The Panic of 1873 was America's first economic crisis caused by financial speculation and investment. One of the main causes of the collapse was the domestic decrease in the value of silver currency. The German Empire stopped minting silver coins in 1871, which hurt the U.S. because it produced much of the global supply. This prompted the U.S. Congress to change its own policy regarding minting silver coins in the Coinage Act of 1873, which lowered silver prices, decreasing the amount of domestic money available and creating higher interest rates. Such rate growth hurt industries that carried heavy debt loads and businesses seeking funding for expansion. These financial challenges led to concerns about American economic stability, which lessened interest in long-term securities like bonds. At the same time, though, the railroad industry was experiencing dramatic growth during the decade after the Civil War as the country expanded westward. Such large infrastructure projects required significant financial capital and couldn't provide short-term returns to investors, so many of them were financed by bonds. A final cause of the panic was two major fires that occurred in Boston and Chicago during the early 1870s, which led to significant property losses and increased the strain on banks. The panic truly began with the collapse of J. Cooke and Company, a major financial company at the time. In September 1873, Cooke held millions of dollars in railroad bonds that it was unable to sell both domestically and internationally due to the issues previously mentioned. A government loan fell through in that same month, and on September 18th, the company declared bankruptcy. The collapse of J. Cooke and another similar bank soon after led to a number of issues within the financial sector. The New York Stock Exchange closed for 10 days in late September 1873. Total miles of annual new railroad construction decreased by 80% between 1872 and 1875. Thousands of banks and businesses failed, and unemployment rose to over 8% by 1878. One of the most significant effects of the failure of J. Cooke was the disruption it caused in the railroad industry. Over the previous several years, immigration and movement of rural workers to cities had increased, leading to higher competition for jobs and lower pay there. The final straw occurred in the summer of 1877 when the Baltimore and Ohio Railroad cut wages by 10%. This led to strikes and violence in several major cities. It began in Martinsburg, West Virginia, on July 14, 1877, when strikers blocked freight trains from exiting the station there. Local police and West Virginia militiamen were unable to end the strike given that some of them supported the strikers, but federal troops were finally able to remove them and allow trains to pass. Protests spread to Baltimore from July 16th to the 22nd, with the peak of the strife occurring on July 20th. Two regiments of the Maryland National Guard clashed with striking workers, rioters, and local citizens in downtown Baltimore. At one point, members of the National Guard fired on an attacking crowd, killing 10 people and wounding 25. Additionally, rioters injured several members of the National Guard, burned portions of the local train station, and damaged trains. Another major city affected was Pittsburgh, which saw the most violence due to the strike of any city during late July. Units of the Pennsylvania National Guard killed and wounded around 70 people, while strikers burned 39 buildings to the ground and destroyed over 100 locomotives and 1,200 train cars. Similar violent clashes between rioters and troops occurred in Chicago on July 26th. Finally, smaller riots occurred in cities across upstate New York, along with Philadelphia, Scranton, Reading, and St. Louis. Throughout the strike, President Rutherford B. Hayes moved federal troops between cities where violence was occurring, which gradually broke its momentum. The strike finally ended after about a month and a half. 100,000 people were involved with it in total. The strikers ultimately did not win or receive higher wages. However, their efforts had a positive impact on improving organized labor and workers' rights over the next decade. For instance, Congress created the Bureau of Labor in 1884. Additionally, the Baltimore and Ohio Railroad began offering a pension plan and created a relief association that covered illness, workers' compensation, and a death benefit in the early 1880s. European countries also felt significant effects from the panic, especially in Germany and Austria-Hungary. Germany had recently achieved military victory over the French in 1871. Excitement from the victory and funding from war debts France owed led to financial speculation in railroads and infrastructure similar to what occurred in the U.S. Germany also exchanged its silver coinage system for a gold-based one from 1871 to 1873, leading to currency problems. The Vienna Stock Exchange crashed on May 9, 1873 due to these stresses, leading to a number of bank failures and a bursting of the railroad speculation bubble. Germany's financial woes were only heightened when the war debts from France ended in September 1873. Britain and the Ottoman Empire also felt some effects from the panic. However, the financial problems felt in these two countries were not as profound as those in the US, and recovery from the crisis occurred more rapidly in Europe. The financial depression caused by the Panic of 1873 ended in March 1879 in the US. One long-term effect of the Depression was that it contributed to the end of Reconstruction in the South, as there was less enthusiasm for such efforts in the northern states. Additionally, the financial struggle severely hurt programs to expand railroads across the South, leaving those states in dire financial situations. Finally, federal troops had to be redeployed from the South to northern cities to end railroad strikes. Much like what we witnessed in the aftermath of the Great Recession and the economic struggles of the past few years, the prolonged economic depression of the 1870s concentrated money in the hands of fewer manufacturers and allowed the largest to prey upon weaker competitors. By 1890, the top 9% of U.S. individuals controlled 71% of America's wealth, a level of inequality only matched by roughly the last 20 years.